for getting us those details. Now, you've probably experienced this yourself, and you've probably had conversations about this. Tax can be a little complicated. But Pranav, is this more complicated than it should be?
Oh, I think so, yes. There's no doubt about it. Even I would have to go back to the book and refer what the tax treatment in certain situations will be, because of the fact that over a period of time, and very legitimately, various things have evolved with the result that it's become quite complex. Depending on the nature of the asset, whether it is financial instruments or otherwise, within financial instruments, what is exactly the nature of the asset? What is the period of holding? Has the transaction been on market or off market? Is it STT paid or not paid? The period of holding, whether it should be 1 year, 2 years, 3 years. And it's gotten quite complex over a period of time just because of the way in which it has evolved. And then again, within the nature of the asset, apart from the status of the SSE, resident, non-resident and so on, whether the nature of the asset, if it is REIT, InvIT units, there's certain things for long-term, short-term, 3 years. For other listed securities, it's something else. So it's just getting a little too complicated, and people tend to probably go back every time and figure out what exactly will be the tax treatment. That's not a hallmark of a great tax regime. A great tax regime normally should be simple, so that the taxpayer pretty much knows very easily what is his likely tax liability in certain situations. So I think there is a need, a real need, to simplify and rationalize the capital gains tax regime rather than have too many categories of assets and too many different treatments. It would be good to have very few categories and very clear logic and rationale for those 3 buckets or 2 or 3 buckets, and the tax rates, the period of holdings and so on being very clearly clarified for each.
We will talk about what an ideal scenario would look at, Pranav, but before we do, I would like to talk about the elephant in the room, if you can call it that, because every time there is buzz about an increase in the capital gains tax on equity, then equity markets react. If at all there is an announcement in the budget pertaining to the increase or the decrease in long-term capital gains tax, then there is a massive reaction. The last time there was a change, it was 2018, but I want to go back all the way to 2004, because this is when long-term capital gains tax was removed. STT, Securities Transaction Tax, was introduced. The interpretation for those that were not really tracking the market or taxation at the time is that one was introduced in lieu of the other. Is that the right interpretation?
Oh, absolutely. And that was very clearly brought out in the finance minister's speech in that year. I think it was Mr. Chidambaram, who introduced the Securities Transaction Tax just to simplify the tax regime and make the collection of taxes also very simple, and for taxpayers not to worry about the tax while deciding whether they are buying, selling, the point of time of buying and selling and so on. So essentially it was introduced as a simplification measure and as a substitution of the listed long-term listed securities capital gains tax. And in that year itself, I think the collections were pretty robust. I think it was less than 12,000 crores. But I mean, in fact, 12,000 crores was about in 17, 18, if I recall right. And from that itself, in the last 6-7 years, the collections have tripled. In 2004, it was pretty nominal. In 17, I think it was less than 12,000 crores. Now it's expected to be, as per the budget estimates for this year's interim budget, it's expected to be more than 36,000 crores. And if the actual numbers are to be looked at, probably it's going to bust those numbers.
Because we have data from April to June this year, and incidentally, it's a 128% increase on a year-on-year basis. We're talking about 16,000 plus crore rupees just in those 3 months, Pranav.
Correct. So I have no doubts that 36,000 number will be busted in all probability, unless the budget upsets the capital market, so to say, which is unlikely, I think.
So the reason why...
And last year it was 32,000 crores for the full year revised estimate for 23-24. And this year, 3 months, you are saying it's...
Yeah, so this is a factor of the number of investors and the volume of transactions, ultimately, right?
Absolutely.
And with the kind of increase in the participation in the equity markets, you've seen this value go up as well. Now, talk to me about, say, it's 20 years of STT. It's done well, to say the very least, and it will do well. But the reintroduction of long-term capital gains, people were not too happy about that. Of course, there was grandfathering and all of that. But then now there's there was buzz in the run-up to the budget that it could be raised again. Is there a case for that?
Oh, I don't think it is very likely. Of course, one can never rule out anything. I don't think it is very likely, because I think even the government realizes that this was in addition to the STT in any case. Second, I think there is a realization that Indian investments into productive assets like securities and shares and financial instruments is something that is really charging up the economy. And to an extent even giving a fillip to entrepreneurship. So I personally do not think that this 10% is likely to go up, but yes, indeed there is a buzz, or there is fear, let's put it that way, that it could go up under the guise of simplification and rationalization of the capital gains tax regime. Well, I do think, if at all, one hopes not, but one cannot be sure, if at all, probably the short-term capital gains tax could go up from 15%, but I do not anticipate the long-term capital gains tax going up from 10% because of the various factors. One, that we are talking of investments in productive assets. It is the domestic investor who has really ensured that capital is available in what was otherwise always regarded as a capital-starved country. So while foreign investments have been really very tempered, very moderate, so to say, if I might say so at all, it is the domestic investors who've kept the capital markets, the flow of capital into business really sustained. So I don't expect the long-term capital gains tax to go up in this budget. Short-term capital gains tax could be, probably, because of the fact that only 1 year is long-term, and there is a feeling that one wants to probably temper the euphoric mood or the stampede in capital markets where people want to trade and do even F&O kind of deals and so on. So that tempering probably and getting a little more longer term mindset might be the philosophy, and at the same time 15% looks a real good rate. Of course, with STT in place, even that can be probably debated, but I'm just telling you what probably at worst could happen is my feel.
Based on the share of India and global derivative trade, it wouldn't be an exaggeration to call India a trader's market. But having said that, let's talk about how what you said could pan out. A rationalization of the treatment of capital gains could result in an increase in the tax ultimately. And my curiosity is whether this can take place without even changing the rates. Because if you were to, for example, say that all capital gains will be considered long-term if it breaches 2 years or if it breaches 3 years, automatically people selling at less than 2 years will be taxed at 15%. So you're ultimately increasing the tax collection.
Undoubtedly, that also is something that cannot be ruled out. So one is the tax rate, second is the period of holding. One cannot rule that out, and if we look at the international scenario, there are different countries having very different models.
How do they work?
Yeah, so for example, there are some countries who don't distinguish between long-term and short-term at all, like Canada, UK and so on, Denmark for that matter, Indonesia. So they don't differentiate between the two. There are some like US, Australia, etc., which have the 1 year rule. Some countries like France have the 2 year rule for the cutoff between long-term and short-term. So there are very different models, but I think in India, this 1 year model has worked quite well for a long time. And I would feel this government has focused very rightly on maintaining some form of stability in the tax law, which is a great virtue, because investors, whether in India or abroad, are looking for predictability, are looking for stability, are looking for some form of certainty when they are taking longer term decisions. So I do not think this government is normally induced with the desire to tinker too much. So I'm not anticipating that, but yes, that's another way of probably saying that if you extend the period from 12 months to 24 months, you automatically, within that 1 year, 12 to 24 months, whoever sells pays 15 instead of 10% if the rates remain the same. Certainly a possibility, I wouldn't rule it out, but I hope that's not something that they are looking at.
Okay, so it's not the ideal solution.
I do not think so.